Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Juliann Gumulak-Smith. How you doing today, Juliann?
Just great.
Good. Well, glad to have you on the show. Tell us a little bit about your background before we dive right in here.
Yeah, so I would call myself an investment educator and money coach. And I kind of had a roundabout way of coming into the financial community. I like to tell people I use the Goldilocks method of finding my life purpose. And really, my first career, I was a molecular biologist. And so I mainly did lab research. And what I found over time, though, I felt like I was contributing to society, I really wouldn't see those results until like 10, 15 years down the road. So I felt very isolated. I really missed person-to-person connection. And, around that time, through that realization, my husband actually got laid off from his job. My youngest child was just 6 months old. We moved our family 1,000 miles away, and I became a stay-at-home mom overnight. And about 2 years into being a stay-at-home mom, my dad actually came to me and said, "Hey, do you want to attend the seminar about the stock market?" And that really, really completely piqued my interest. I didn't know how the logistics was going to work out, who was going to watch my kids, and how all that was going to happen, but I knew I had to attend that seminar. And that weekend really changed my life. That was my first exposure to the stock market. And from there, I took classes for about 2 to 3 years with a company called Invest Tools. They are kind of under the umbrella of TD Ameritrade now. And, I would get up at 3, 4 o'clock in the morning to either take a class, listen to a seminar, look at my stock charts. And that really was like my sanity and sanctuary when my kids were young. It really was a time that I just felt like myself and I could have thoughts other than being a mom. So it was a lifesaver when my kids were young. And, but that was something that just my dad and I talked about. I really didn't share it with family or friends that I was doing this. It was just something my dad and I did, so we, would talk about the stock market every day. And then in 2012, I had like a minor car accident, not a huge one, but a big enough one that I was like, okay, I need to make some changes in my life. And through that, I studied to be a life coach. And when I got done with life coach training, everyone's like, so, what's your niche? What's your specialty? And, I struggled with that for a little while. I first started coaching people on career changes because that was something I could speak to from a molecular biologist to a life coach. And then, but again, it didn't feel quite right. And then I coach people on relationships because there was a time when my husband and I were separated, and there's a lot of skill sets to learn during a transition like that, but again, it didn't feel quite right. And then what I was noticing is that it seemed like everyone around me was going through either a divorce, some life transition, a career change, a move, but they were actually approaching me about money. And then that is kind of when I realized not everyone knows what I know about personal finance and the stock market. I think kind of up until that point, I assumed everyone kind of had this general background. And that's when I realized that, oh, that's easy. That's my life purpose. This is how I can best serve my community. And I mainly, out of that, I formed the Investment Academy for Women. And I tend to focus on women just mainly because we are socialized a little bit differently around money. Just in general, women are taught a lot about, okay, save your money, use your coupons, be thrifty, whereas men tend to have a little bit more, okay, invest your money, grow your money. So it's a little bit different. So I like to work with women just to make that transition into more of a growth mindset with money instead of a saving mindset with money. Because there was this great commercial. I don't actually remember who made it, but there was a woman who wanted to like climb the Himalayas. This was one of her life goals, and they would show her through the years putting money in a money jar. And then you see her a number of years later, she's like in her 80s with a walker, but she is, climbing the Himalayas. And then somebody cuts to someone saying, if she only had invested her money, meaning she could have got there a lot faster if she just had invested her money. So I like to, pass that along.
Nice. Well, I can, yeah, I can appreciate that. That seems to be the path, and everyone wants you to grow your money and invest it, and Wall Street wants you to do that anyway. So what have you found kind of, in working with different people, I guess women primarily? Do you work with men as well, or just only women?
No, I work with men as well, as long as if it's in a group setting, if they understand the focus might be a little bit different.
Okay. So what do you find is the biggest challenge for women that you talked about, kind of the growth mindset, but what do you find is the biggest challenge? Because I've found in my career, they're wired very differently than men, and not in some ways good, in some ways bad, but there's definitely differences. Right.
What I see when somebody comes to me, there's really two main things that we tend to work on. The first is mindset. So there tends to be some, I'll just call it limiting beliefs, either societal, generational, about money and limits to money and just being comfortable with money. And there seems to be a great deal of fear and anxiety just managing their own money themselves. So that is one aspect that I focus on. So, what kind of skills can you learn? And I find that, the anxiety and fear really dissipates once you just get a good financial education. If you just start there, it doesn't feel as scary. Once you start learning the language of investing, so you know how to talk about money, you start understanding what different funds means and how the stock market works. So that aspect. And the second part, like I said, is really educating about the stock market and asset allocation. And, there's just simple things everyone can know about the stock market, just so they can have these meaningful conversations with their family, their partner, their financial advisor, and really make it more interactive rather than just nodding their heads, because that's another thing that women tend to do. We'll be in a financial setting with a financial advisor. Let's say it's a husband and wife, and that financial advisor seems to just target on the husband and not necessarily the wife, even though the wife might actually have more education about investing than their husband. So I really, like people to gain their confidence and have meaningful, interactive conversations about money with, like I said, their family, financial advisor, their partner, because I don't know, most families really don't talk about money. I know growing up, my dad's a certified public accountant. So you would think we would have talked about money all the time, but entering the world, I think the only advice he gave me was mortgages and car payments are acceptable debts and everything else is not. So, that really struck me, but that really was the only financial advice I was given. So I remember, writing my first check. I signed my name in the wrong spot the very first time I signed a check back in the days when people would write checks. But, I really entered that financial community very ill-equipped. So, the thought of, let's say you're signing up for your 401k plan with your employer and they give you, okay, here are some funds, that to me initially was overwhelming. So how can we have people make good choices in that first initial setup, that because it impacts your life so much, down the road?
Yeah, no, it's funny you say that. I think it's a societal problem. things that people don't talk about. They don't talk about religion. They don't talk about sex. They don't talk about money. And you don't talk about politics in other people's company, but in your own family. So this feels like all of these really important topics people should be talking about, and they don't. And money, certainly growing up, I had the same thing. Like nobody talked about money really growing up. And but I did want to touch on, you mentioned limiting beliefs. So what are some of the limiting beliefs that women have that are, I guess, more common, specific limiting beliefs?
I can't spend my money. I have to save my money. It's another one that comes up. I don't have time to manage my money. This is too difficult for me to handle myself. I'll leave it up to someone else. But there's, the general things like money doesn't grow on trees. Those come up a lot. Let me think of if any other ones. I know for myself, I had this belief for a while. It's the thought of somehow I've missed the boat, like with making money. Somehow I missed the boat because I had a family friend whose family, they contributed to the YMCA, and their names like up on a plaque as a contributing, consistent contributing member of the YMCA. And I was like, wow, somehow I really missed the boat, like about money, like somehow, I didn't do the right things. So, that you just have to really catch whatever's going on in your mind and actually reset it and rephrase it. Because, your brain is kind of wired. Once you have that thought, it's easily going to have that thought again and again and again. And it kind of makes its own pathway that just thinking the opposite of it or changing it will help rewire your brain to start changing your beliefs and feeling differently about money.
Yeah. So one question that kind of comes up is, the difference between men and women when it comes to investing. I've noticed you make broad brush statements. Obviously, everybody's different, but, what do you notice are kind of the big differences between men and women when it comes to investing?
I would say the main difference, women tend to be a little bit more conservative and consistent, whereas men might be a little bit more to go after or do a little bit more risky and maybe go after the shiny penny a little bit more. Those are the main things. And yeah.
Okay. So getting into the stock market, let's kind of talk about this. So you educate women on how to invest. What are some of the common mistakes that you see investors making that could be easily fixed?
Or at least for women, is actually contributing to their 401k plan. I think there was a study by Go Banking Rates. They had surveyed about 1,000 women, and only 17% of them who were eligible for a 401k plan actually did that. That like shocked me. Because oftentimes women, we think our salary is good for the family. Like we're not necessarily using it for ourselves. It's more for benefiting the family. And, unfortunately, the greatest population in poverty is elderly women. So the first thing that I want to make sure they're doing is doing some type of contribution, either it be a 401k, a Roth IRA, a traditional IRA, whatever vehicle. But that first step, most, like I said, only 17% of women out of that 1,000 were actually contributing to their retirement account. I think the younger generation is a bit better than like my generation, but that is, where we at least begin. And then, we do go through, what different funds means, like a growth fund, fixed income and that. But, besides from not contributing, I would say sometimes starting off a little bit too conservative when you have a longer time frame. I know for myself, like the funds that I set up for my kids for college funds, I was, a little bit too conservative, giving the time frame. I was a little bit more too conservative.
So, one question I always ask, because I find it challenging to answer as well, is, what kind of advice do you give people that are doing it themselves? I mean, you're teaching, women how to invest, but you also have, a certain type of investing style, which, which may not be easily replicatable just by, telling somebody something for 5 minutes. So what advice would you give people? It's like, all right, just give me some 5 minutes of advice, and what should I do with my investing? Like, how should people think about investing in that way?
I do believe you have to think more long term. So I do not advocate going in and out a ton of time, unless if you're actively an active trader. It's hard because, last year we were in a bearish market. So everyone kind of freaks out and wants to do something different and kind of trade at their own. But I start with, okay, it's like, first, let's learn a little bit about the stock market. So I go into a way of, the different sectors of the stock market. So we go through that education of the different sectors of the stock market, like healthcare, energy, technology. We'll go over that. And then I also like to cover just a simple way to know if you're in a bullish or bearish market. So I use the 200-day moving average, and a lot of traders do that as well, as a simple gauge of, okay, what kind of, am I in a bullish market or a bearish market? It's not necessarily to say, oh, I'm going to be in or out, but it's like just giving you a heads up, like, okay, I'm in a bearish market, so my growth funds might not do well this year. It's more understanding, okay, this part of my portfolio is not going to do well because interest rates are going up, so my bonds are not going to do that well, and not have anxiety around it, kind of understand, okay, this is what's going to happen in this type of an environment. Because, the last 10 years, it's really been a growth environment. And I think as we are moving forward, it feels like, instead of, oh, I can just be in an exchange traded fund and I'll do fine. What I'm finding more now is that things are being more selective. The fundamentals are coming in more. It's not a blanket of, okay, I'm going to be in the SPY. Things are becoming a little bit more selective. So I will say, there's a couple of resources I would love to share that really helps with just kind of finding what the overall market is doing that's available to everyone. There's a great website called etfscreen.com. And what it does, it gives you the main screen really is a nice display of what the overall market is doing. And also will show you internationally. So it'll show, Asia, Europe, and some commodities as well. But it has a nice visual representation about how the market is doing. And you can, select it depending on your time frame. So they have a day, 5-day, 1 month, 6 month, 1 year. So, whatever time frame you're focusing on, they have a nice way of going in between those. So, and also on in that ETF screen, they have, you can actually look how the stock market is doing by sector. So if you select that, it can actually, tell you again how these different sectors of the stock market are doing and kind of the relative strength. So you can kind of easily visually see, if certain sectors of the market are outperforming others. So that's a nice resource. And I know as I was talking about the 200-day moving average, there's a nice website called stockcharts.com. And you can just simply put in, they have a search bar and it's called sharp charts. And you can simply put in the ticker symbol SPY. And that gives you, and it automatically defaults, it'll show a 50-day moving average and a 200-day moving average. And it gives you just, a simple free resource that people can go to just to have a look at the stock market and what it's doing over the last 6 months, because, sometimes you have to have blinders on or not listen to some of the financial newscasts. They're saying it's the end of the world, but, if you look at the chart, it's not necessarily happening at that moment. Doesn't mean it's not going to happen in the future. But again, that's a resource people can use to kind of not have so much anxiety into the day-to-day of the stock market.
But I would imagine, I do this professionally. You've done this for a while. When you have a certain level of knowledge, you become a lot more comfortable with this stuff. But I think if somebody's new to this,
Yes.
It's scary. There's a lot of things that they have to learn. And I've been doing this I've been interested in the stock market for probably close to 30 years. And there's always more to learn. And every time you figure you've learned a lot, it's like there's another rabbit hole you can go down. So, how can people kind of overcome that overwhelm with the stock market? I think like men generally will just say, I'll figure it out, or I know more than I know. And women are maybe on the other end of the spectrum where they're a little more timid about it. But from what I understand, at least statistically, women tend to be better investors.
Yes.
So hate to say that, but that's what the data says.
I didn't want to bring that up, but yes.
No, bring it up. There's something about that. So what is it that makes women better investors?
I think they will take more time to actually go through the educational process and actually go into the market a little bit more step by step, more sequentially, whereas men probably kind of jump in more and figure things out as they go, whereas a woman maybe will take a class first and have an educational foundation. It's interesting because there's different ways that people take action. It's called the Colby Index, and just in general, some people like me. I'm a fact finder, so this is a person who takes a lot of time to research everything, analyze everything before I would ever take action on anything. And then there's people who are implementers. So these are more people who are more likely to jump in and figure it out as they go, which tend to be men. And then there's, so just innately, just knowing kind of how you take action helps you kind of tailor your education and investing based on kind of how you take action. Like,
okay, yeah, no, I love the Colby Index. It's something I've spent a lot of time with, and it's really helpful when it comes to understanding yourself and other people, and the cognitive score doesn't change, which is the best part. You take these personality tests, and they, depending on how you're feeling, you could come up with a different score. And well, with the Colby, it's probably one of my favorite ones that I've used, and it's really easy to take. So if listeners want to do it, it's just kolbe.com, and you take the Colby Assessment A. It will give you a lot of insight into yourself. And Kathy Colby wrote a book, The Cognitive Connection, as well, which if you're really interested in the details, you don't need it, but if you're really interested, it's a good book. So well, great. Well, so Juliann, what are some kind of final thoughts you can leave us with when it comes to learning about investing and some basic skills that you think people should learn?
Yes. So I do want to emphasize that you don't have to be a rocket scientist to understand the stock market. It's really just learning a new set of skills. So the overwhelm that people feel when they're learning something new, that is normal. Think back to your first biology class. There was a ton of vocabulary to learn and, new information. So kind of dissipating that overwhelm is really important, to really kind of break it up into little sections. Martha Beck has a great technique called turtle steps. So when I walk people through learning about the stock market, we don't spend 45 minutes just going over vocabulary. That will lead you right to overwhelm. I break it down to short, simple concepts that are easy to go through, and that really lessens that overwhelm. And because I've heard other people who have taken other financial classes and they ended up just looking at the curriculum, they get overwhelmed in that moment. So if we can just break it down into small bite-sized learning lessons, learning about the stock market, again, it's just like learning any other skill, but a little bit at a time.
Nice. So, what can you leave us with some good books you think people can read that would help in getting educated?
I guess I have a little biased. I have a book called Charting Your Way to Success by Tim Knight. And then I have Candlestick Patterns book by, oh gosh, it's behind me. I would have to run and get it. But I love that book. Yeah, so those two, the first one focuses on looking at trends and charts, and if you're in an uptrend, downtrend, things like that. And then the other one, it focuses more on candlestick patterns. So how looking at candlestick patterns can help you kind of look what the stock market might be doing on a short-term basis.
Nice. Oh, great. So, all right. So where can people find more about you?
Oh, sure. Yes. So I'm at investmentacademyforwomen.com. And I do have a couple of free resources on there if people want to check it out. I have a downloadable of 5 easy ways to grow your money. And then I also have 3 simple steps to tend to your financial garden, if they want to check that out.
Great. Well, I'll put that in the show notes, and for all listeners who want to check that out, you can go to the show notes and you'll find those links there. But Juliann, I really appreciate you coming on the show and sharing your wisdom with us. And yeah, thank you again.
All right. Thanks so much.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Juliann. Really appreciate her coming on the show. Now we're getting into the panel portion of the show where we have our very own Doug Heagren. Hey, Doug.
Good morning, Kirk. How you doing? Looking forward to talking to you today, talking about this.
Great. Well, glad to have you on the show. And we also have a brand new panelist, Tim Baker. Hey, Tim.
Hey, Kirk. How are you? Thanks for having me.
Thanks for coming on the show. Well, glad to have you here. You were also a guest on the show recently. We're going to have you on more. So I know I'm excited to have you here. So, Doug, why don't you just dive right in with you? So what are some of your takeaways from the interview?
Well, yeah, Kirk, I think, I think that women in investing has definitely is a unique area. They come from a different perspective on how money means to them. Many cases, can be a little bit more. I'm not saying this is in all cases. I had several clients who are the exact opposite of this, but in many cases, can be a little bit more fear-based, and certainly left with more of the financial burden long term. If you think about longevity in life, et cetera. So it is, and they have increasingly taken over more and more of control of the financials in households over the years. And obviously there's been the cultural shift that's happened over the last couple of decades to where I think if this is something you're not recognizing and understanding from emotional, financial base, especially with clients that somebody might be working with, you may be, again, if you're following the old school planning methodology and not taking into consideration, you may be not only missing out on critical things that need to be planned, but you also may be missing out on your ability to communicate it to who's really going to make those financial decisions, as they are definitely they are definitely much more of a decision maker than they've ever been.
Yeah, I couldn't agree more. Tim, what about you? What are some of your thoughts and takeaways?
Yeah, so I would echo a lot of what Doug said, but I think the key here is if you think about the legacy of this industry, the industry has been a very male-dominated industry, and we have tended to focus our conversations on that kind of mindset, that psychiatry. So, one of the things that gets talked about is education. And I do think that we need to start broadening that education conversation. Men and women, to Doug's point, have very different ways of absorbing information. And so actually one of the things we try to do here at Metric is try and take everything down a couple of notches, because as you guys both know, I'm not sharing anything new. Other than maybe the medical profession, there are very few industries that have more jargon than the financial industry does. And for those of us that have been doing it for years or decades, in our cases, that jargon is very second nature. It's like saying and or the. But then you get into a conversation with somebody who doesn't have that kind of education, and all of a sudden you start seeing eyes glazing over. So that was kind of the big takeaway for me, was really re-steering the education conversation into a language that everybody can understand.
Yeah, that's a great point, Tim, and that's one of the points Juliann raised about, a lot of women, like if you're sitting in with an advisor and you're let me rephrase that. We are advisors and we're sitting in front of a couple, and frequently the women will feel like they're not getting addressed as part of the couple. Like typically advisors focus on the man and they don't focus on the woman. And sometimes I find it challenging because I always try to involve both parties, but at the same time, I find sometimes women are a little bit more reticent to share, and if you involve them, they'll come out of their shell. But I think they tend to be a little more shy, feeling like that they don't feel like they have anything valuable to say, or they feel like I'm going to let my husband do it, or all of these kind of mental models they have going on in their head, where it really just comes down to they're not confident in themselves to deal with this. And I think one of the takeaways that I thought was really interesting. It wasn't news to me, but it's something I always find really interesting, which is women are way better investors than men. And stats show that. And it's a male dominated industry and women are better at it. So to me, I just find that fascinating, and maybe that's going to change. But I don't know. I mean, I think there's certainly different kinds of investing. I mean, Juliann talks about a lot about charting and technical analysis, which is her methodology. But Doug, any suggestions for how women could get more involved with investing, and how maybe our industry can do a better job at getting them involved in investing?
Yeah, I think really, which I kind of find the irony of the charting and analysis, because technically when you start getting into charting and analysis, you start getting into the jargon again, which is one way I have found to very quickly, on often, and again, I say these things as generalizations, not, there are always exceptions to the rules, but in many cases, it's getting into those jargons and those terminologies and these things that are, and the numbers that, in many times, that's the thing that I find will be the number one way that women tune out. Okay. Men are from Mars, women are from Venus, the book that was around years and years ago. From a, emotionally speaking, we're very different. We are very different. Men tend to be more visual, maybe tend to be a little bit more into like those numbers. Women tend to be more into the vision, to the emotion, to the picture, and things like that. So if you're just getting into technical numbers and logic, it can very quickly lose you in this conversation. I find, and you talk about, women being better investors than men. And I think a big reason for that has a lot to do with risk taking. Men live, driven by just bigger, better, faster, flashier things. And again, there's exceptions to both rules. I've seen bigger, better, flashier women as well. But for the most part, women tend to be a little bit less in risk taking. They tend to make more decisions based off of, predictable, achievable outcomes, or how is this going to get me to a bigger vision of a goal, where men can be driven by money and really, I find a lot of time working in these couples is getting through what families' values are and what people's values are. And a lot of times you'll find that for any number of reasons, culturally, upbringing, etc., sometimes that we lose a connection of our values to why we're doing what we're doing, right? It's just, I want to have more money, but why? When you start getting into conversations with families, where I've found a lot of success working with families, and I have a lot of clients where it is an alpha-driven female in the family. They know what they want. They are definitely involved in that process. A lot of the communication goes to them, but the conversations have a lot less to do with the numbers and a lot more to do with the vision, okay? And what is important about what money can do for them, what is important about what they are building for and achieving in their life. If they lose that vision, the numbers mean nothing. I think Ameriprise did this very, very well. And it's funny, there's a new show out on Netflix, How to Grow Rich. There's some things in it I agree with. There's some things I don't agree with. But what I do think that they're doing a very good job with is he has everybody kind of fill out your rich life booklet. 15, 20 years ago, Ameriprise tried this with the Dream Book. Okay. And I thought, of all the things, I don't think they marketed it very well. I don't think they really taught and advisors used it very well. But of all the things that was ever created there that I found had the greatest impact was the use of this. Here's your homework before we ever get into the numbers. Let's get beyond the numbers. Let's put down what the vision is. And then let's focus on that as the reason we make every decision. I used to say, my job is to look at that future you and protect the current you, protect them from the current you, right? Because there's this sensational wants that are just going to fight us. And you're going to make those decisions that could impact that. But if they have that vision, that emotional connection to it is critical before you're able to go into any decisions or implementation logically. You have to understand the why. And I think that means a lot more with women than men. Last thing I say, because I know I've hijacked this a little bit, but statistically speaking, it's kind of similar to what we learned years ago. The numbers say that women get in more car accidents. And it was like, they're bad drivers. No, they actually do, but they're fender benders. Men get in more deadly car accidents. They're the ones driving out there at 115 miles an hour, smashing the car up and never walking away. And I think that comes to the same thing on investing. Listen, both sides are going to make mistakes, but how big are those mistakes going to be, and how can you recover from them? And I think there's an area where, emotionally speaking, the planning, yeah, there might be some pitfalls, but that vision to the future and what gets implemented to get there, there's going to be a lot less things that ultimately end up collapsing it completely. versus the brashness that a lot of times comes with, machismo and testosterone.
Yeah, no, I tend to agree. I mean, men tend to be easier to take risks. They'll just jump in and just say, all right, it's worth taking. And women will actually think about it and be more calculating about it. So that makes a lot of sense. Tim,
we live in the now a lot more.
We do. We do. So Tim, what about you? How do you kind of deal with couples and as an advisor yourself, like how do you deal with couples differently, because obviously they have different kind of ways of looking at things and probably different ways that they handle the family's finances.
Yeah, a couple of things. So I was kind of laser focused on one of your comments earlier, Kirk, which is when you sit down with a couple, oftentimes the woman is more reticent to have the conversation. And I always try to keep that in mind because I came up in this I started in this industry in 1996. And I came up in this industry, with movies that are very stereotypical, like, Boiler Room and, Wall Street and things like that. And I always try to be very cognizant. Why? Let's think about why the female would be more reticent than the male to speak and share thoughts. I think there's some sensitivity to how this industry has typically behaved in the past. I don't mean to beat a dead horse, but this has typically been an industry that targeted its conversations towards men and less towards women, which I think is a huge missed opportunity for a lot of people. As Doug alluded to earlier, women are controlling more and more of the household finances nowadays. And I would say a couple of things. Number one, in terms of how I try to deal with that when I am sitting down with a couple, I actually focus more of my attention on the female in the room, whether it's a girlfriend, a wife, whatever it is, because I do want to make sure she feels that we are paying very close attention and we do want more of her feelings. But also because of what you guys both alluded to, the female in the relationship is going to be the one I get more information from. Right. So if I'm directing my conversation and asking questions of the boyfriend or the husband, right, I'm going to get more like, how much can we earn? How do you invest? I'm going to get very little about what are we trying to accomplish here? That's what I need to know, right? If I'm a traditional broker slinging stocks and bonds and, I don't care about any of that stuff. I'm just trying to earn a commission. But if I'm a fiduciary and I'm really trying to understand somebody's financial picture, I will focus most of my attention on the female in the room because I'm probably going to get more information from that person, in terms of like what it is I'm actually doing, right? What's one of our biggest concern in this industry? Litigation. How do you get sued? You have somebody in the wrong investment, something that's unsuitable, it's inappropriate. And if somebody sits down and says, hey, I'm giving you 500 grand, do whatever you think's right with it. Great. Thanks for the new business. What am I doing with this? Do you need this in 6 months to buy a house, or do you need this in 15 years for retirement? And I do find that conversations and directing most of that conversation towards the female will get more at those goals than as Doug alluded to, the here and the now.
Yeah, I agree. You tend to get a lot more stories from the women and tend to get even some of the stories the husband doesn't want to share. But like, oh, the time that he made that stupid investment or whatever. And so, yeah, I completely agree. So, one thing that came up in the interview, because Juliann, she does charting and technical analysis. And one of the questions I asked her was basically like, yeah, that's all well and good, but how do you educate new people about that? I mean, that's a skill, right? And I think one of the challenges, I mean, all three of us are advisors, so we have experience in working with clients. So I want to kind of ask the question around the horn here, which is, it's one question that's always struck me as harder than it seems, which is, let's say I've got a family member. So I don't work with family. It's one of my rules. I won't work with friends, won't work with family, because it just changes the relationship. It's just not worth it, right? So what I've been asked many times is, what would you do? Like, what would you recommend to somebody that you recommend it once and you don't have to worry about it again? And I say this because both of you probably realize this. You go home for Christmas, you talk to the relatives like, oh, what should I do with this company? What should I do with this company? And you give them some answer. And then they yell at you next Christmas because you didn't tell them to sell. Like, well, I didn't talk to you in 12 months. Why? I didn't tell, you asked me a recommendation, I gave it to you, but I'm not around to give you the other side of the recommendation. So then they blame you for it. So the context around this is like, I'm just thinking, like, if I had to, like Warren Buffett, for instance, right? Warren Buffett, one of the greatest investors of our era, arguably maybe even the greatest. The question was asked to him, well, what if you die? Then what do we do? Right. So he kind of posed this, well, I'd put it all in the S&P 500 and leave it, which I think is an interesting perspective, but maybe it's not the best perspective. So I guess the question I would ask is, like, how do you give simple advice to people that they can generally follow without getting too hurt, and also without being around, right? Because if you're not actively managing it, then these people can make mistakes. Charting means you have to actively be involved. You can't just like set it and forget it. So starting with you, Doug, like, what kind of direction would you give to people if they, if they just needed like one approach and could never change it?
I mean, this is a slippery slope, right?
Yep.
Well, let's go back to Warren Buffett, right? I think you made a good point there. I mean, what does he tell people? And I've used this in mockery a few times because I think there's two sides of it. Warren Buffett says, do as I say, not do as I do, right? He sits there and basically says, and people love to quote this, especially, the millennials, Gen Z investors, there's a million things out that says just buy the S&P 500, right? And well, Warren Buffett says, if I was doing this all over again, I would have just bought the S&P 500. No, he wouldn't. But what is he doing? He's mocking you in a way, because he's basically saying you don't have the time or expertise that I do, right? So, one of the things that I would say to family is, and again, we all know he's sitting here, there's pros and cons to each of these things. But, there's a reason that they came out with the 60-40 the model, right? It was, and again, we've seen a lot of holes that we poked in the 60-40 model. And there's a lot, then last year, 2022 was a great example of where that did not work. You could argue that most of the time it has. The S&P 500, same thing. The goal here is that, the goal here is, you basically, there is traditionally 3 places to invest. There's domestic, there's foreign, and there's fixed income. Now you can get deeper into that, into small caps and mid caps and, and emerging markets, et cetera. But what I would tell someone, because again, if I'm starting to give them anything more clear than that, I'm starting to go down a slippery slope that's where they're going to hold me accountable to doing something different. And that's something I've learned even as an advisor. One of the things you're always battling with is if you think that there's something that's going to be in the best interest of the clients are still going to be looking at the news and seeing what the market does. And if it doesn't do that, they're not going to be happy. Okay. So to a degree, if you're not going to be in a position where there's going to be actively management advice of that, you really almost do have to come back and say, passively get a diversified fund and just stick with it. Because the key here is invest and save for the long term. And they've done studies. A lot of people don't watch their portfolios. And the ones that didn't watch the portfolios, what happened long term? They actually did okay. Now, did they do as good as they could have? Maybe not. We all know the S&P 500 was flat between 2000 or negative between 2000 and 2013. So they're going to lose time in that. But at the end of the day, they're going to look at the markets, look at themselves, say, hey, I made money. And most people, I like to joke about this, but math, right? Because people say, well, look at all the money I made on this house I made. And you do the annual return and all the investments, like, yeah, you've held that house for 15, 20 years and you've made this much, but you put this much into it. And at the end of the day, you've got all these other costs and, you made about 3.5%, 4% a year. But I made all this money. Well, you saw the tangible return on it. But your ability to calculate what that actually meant on an annualized return actually isn't your strength. So again, if I'm telling someone advice-wise what to do and I'm not going to be involved with it, you've got to go back to a much more generic basis of the things that are out there. Because otherwise, if it does anything or it's counter to the rest of the information out there, you're setting yourself up for failure. In terms of them coming back saying, wait a second, you told me something different. And that's unfortunately the downside of what we face every day with this access to information. Because the access to information means that no matter what you say, that information is going to find a way of creeping into their household. And what you are doing, if you're not involved in doing it yourself, the information you're giving them better line up at the end of the day, because the chances are if it doesn't, they're going to ask, why did you not tell me what the rest of the world is? If you told me this would be different, but look, that did better. And I think that's the problem, especially with a litigious society and fiduciary. You got to be really, really careful of saying something that's different than what is out there in the general news, even if it may not be the best advice.
Yeah, I think that's that's great advice. So I want to ask Tim as well, and Tim, for those of you who don't know Tim, he's a CFA, and for what that means in Boston language, he's wicked smart. So, Tim, what's kind of your thinking? Because I mean, you've got basically a doctorate in finance with a CFA. So, what are your thoughts on what people can do? Because as Doug says, and a good example is the 60-40 was kind of brought out as like the no-brainer, but yet the 60-40 doesn't work well when bonds are yields are rising. So it works really well when they're dropping, but when it's rising, it may not work as well. So what would you suggest, just from your experience and knowledge of finance?
Yeah, so the first thing you talked about that I liked was and no offense to Juliann, if she's great with charting and technicals, that's great. But it was either Munger or Buffett who said if you're going to time the market, you have two decisions to make, not one. You got to know when to sell and you got to know when to get back in. And I get asked all the time, like, should we be getting out of our stocks? And 2020 is a great example, to your guys' point. 2022 sucked, right? I mean, there was nowhere to go other than cash. And even cash, that's really nowhere to go because cash was earning 0% while inflation was running at 8%. So you were even getting a negative 8% return on cash. But so for stocks and bonds to be down that much, and Doug, I've seen all the articles that have come out lately about the 60-40 doesn't work. And we all as professionals know why that doesn't work. Somebody else might look at that and be like, I don't understand why does that not work anymore? That's always been the recommendation. Well, when 40% of your portfolio is yielding almost 0%, that makes no sense. So the 60% in stocks works, but the 40% in bonds doesn't work. And it's funny because we sent out a note right in the heat of the pandemic in the middle of March 2020, and basically tried to explain to people how duration is the same as beta. And so I should have sent that out at 7:00 at night so everybody could read it for bedtime. But right, so you have risk in bonds that most people aren't aware of, and the lower interest rates go, the higher your duration, and therefore the bigger your risk in owning bonds. So generally speaking, what I try and tell people is, look, there's no upside in me telling you whether or not to buy Bitcoin or Facebook or Tesla. I was just looking at this headline. Tesla now has its 7th downgrade recommendation from analysts on Wall Street. It used to be everybody's baby. So they're great until they're not great. And so I just tell people, like, look, if you're not going to invest, like, so put it this way, somebody comes to me and says, I love you, you're wicked smart, but I'm not going to invest with you. I don't want to pay the fees of an advisor. And then I'll make the argument about our fee schedule and then we'll just let it go. But I basically tell people, like, you can't think about the emotion. 2022 was a great year for people to come and tell me, I'm tired of losing money. I want out of stocks. I want to increase my exposure to cash and bonds. And I said, look, there's a reason cash, T-bills, bonds, everything looks so attractive. If it was a free game, right, then everybody would just flock to that and there'd be no more stock market. So you have to weigh, okay, so we bought a T-bill for somebody today. I think we wound up with like a 4.9 yield on it or something like that. But is 4.9 better than where would the stock market go from here? So it's a rambling way of saying everybody, and it's so tried and true, but just think about your goals, not where is the market now. So the conversation I had with clients last year, while the market's going down, I want to sell. And my answer, perhaps a little bit of a smart ass, why? Do you need the money tomorrow? It's you have to stay focused on the goal. If you don't need the money for 3 to 5 years. So one of the reports that I ran for my weekly report is I went back and ran 3 and 5 year rolling period returns for the S&P 500 going back to February of 1970, which is far back as Morningstar would let me go. If you look over every single monthly rolling period, ranging 3 years and 5 years, going up to the end of last year, if you held on to the S&P 500 for 3 years, you had an 89% chance of a positive return. And if you held on for 5 years, you had a 92% chance of a positive return. So it's the age old, like, don't worry about what the market's doing today, worry about what your goals are. And if the market's down 20%, I hate to say it, yeah, the answer might be we should sell something if your plans have changed. If you've got an emergency and you need cash, there's nothing we can do about the fact that your emergency has come up and we're going to have to liquidate even though things are lower. But if it's not an emergency, if you don't need cash, if you're trading based on fear, don't do it. Stick with your program, and as your goals get closer and closer, move more money to cash and bonds. But other than that, stick with the things that are going to give you the maximum growth.
Tim, I want to jump on that because I think you highlighted the biggest problem that people run into. This isn't about the markets, and people spend too much time focused on the markets as the solution to all of their woes, right? It's like, I mean, why do people care about the return in their portfolio? If you have enough money to the two things you want, the return is meaningless. Whether you make money or lose money temporarily isn't going to matter. The only people that care about that have a worry that there won't be enough. Now that highlights two problems. The first is that the main thing people should be concerned with is cash flow. Income in, income out. Okay. Not just today, but in the future. What do you need to live the life of meaningful purpose that you want to need, and make sure that that is correct. And that's where planning comes into diversifying beyond just your stock portfolio. Like, again, how much Social Security are you going to get? Is there pensions? Do you create your own pensions? Listen, love them or hate them. This is where annuities have, and they have become a great place. Some people like annuities. Like, look, I got this. I got all my expenses covered by my annuity my personal pension. My annuity covers that. All my portfolios now, that's my want money. That's my love money. The things I need are covered. The things I want, I can go to my portfolio when I need it. And I don't care if the market's down because I don't need that money. That's one thing that might be part of it. So where your money goes is to diversifying in different things. But the bigger thing you just highlighted, well, okay, I love what you said. Well, the market's down 20%. Maybe we should do some more cash if an emergency came up. But if an emergency came up, shouldn't you already have the cash reserve to fix that? That's part of planning. If you have enough money elsewhere, access to capital is the #1 cause of financial stress. If you've got to go to your portfolio to cover your basic needs in retirement, to cover an emergency, you have not planned accordingly, and your financial portfolio is not correct.
Yeah, that's a great point. We should make that point now for everybody. If you don't have 3 to 6 month living expenses in cash right now, that's an issue. But Doug, not to beat it to death because you already said it, but it's the first question we start with when people start talking about a savings and investing plan. They're expecting us to say, like, what's your risk tolerance, or how much do you want to own in stock? Our first question is, let's sit down with our software, figure out what's coming in the door every month and what's going out the door every month. And people go, can I get back to you? Right. And it becomes a grueling exercise, but it's really important. It has a huge impact.
I deal with college planning. People don't know this. People do not know this. Cash flow is everything. Every single decision you'll ever make in your life is based on your cash flow. And that is a fundamental epidemic that we face. People have no idea where their money's going. If there's one thing that Dave Ramsey has done very, very well, it's get people to understand and start to look at where is your money going. Beyond that, most of the advice sucks. But that part of it is critical because you can't do anything if you don't know your income versus your expenses.
Yep.
Yeah. And one other thing you said, Tim, which I thought is, we talk about this a lot in the show, but I want to reiterate it, which is, a lot of people look at bonds in a certain light, mostly because of the last 40 years and what that's meant. In large part, the last 10 to 20, which is, bonds in the last 10, they don't really pay all that much, right? You don't get much of a yield in bonds, and they're safe. Bonds are safe. Everyone always talks about bonds are safe. Well, they're not safe. They're another investment. They're just, it depends on whether you're in an environment where yields are going up or whether they're going down. If they're going down, they're safe. If they're going up, they're not safe. That's the simplicity of it. But I think it's important because you made this point of, you just had a client today. He bought a 4.9%, it was a treasury or whatever.
August 15th.
Yeah. I mean, we've been doing that for a while. Like,
Yeah.
treasuries, you're getting close to 5%. At one point before the banking crisis, you're getting 5.2, I think 5.25 that day. And then they imploded. They fell because of the banking issues. But the point is 5% is pretty good. I like 5%, and yes, it's lower than inflation, but God, it's better than maybe getting 5, maybe getting -10, like it's for some people, if you've got 20 years ahead of you, you might be okay taking that risk. But if you've got 5 years ahead of you, 5's looking pretty attractive and, as close to a guarantee as you can get with government, US government bonds. We can't say guarantee, but if you had to put the word around it, that'd be the first thing that would come close to it. So,
But that's an important distinction, Kirk, is when you say bonds are safe, do you mean in terms of their value or do you mean in terms of the credit? Right. So it's accurate to say that whether a bond matured, like, so whether you're talking about Pepsi or the US Treasury or Apple or whoever it is, if you're saying that whether the bond matures in 1 year or 30 years, that it's going to be money good, meaning that it's credit worthy, then yes, you're right. But to say bonds are safe, like I'm always going to maintain that same value in my portfolio. Well, now you're comparing credit versus volatility, and that's, as we've seen, not true. But not only did people get this impression that bonds don't really return much, but they were actually the whole time getting a really good return. I mean, think about how spoiled people were for 30, 40 years, ever since the late 70s, early 80s. Yields did nothing but fall, which meant positive returns for bonds. So people were reaping the rewards of not only great stock returns, but also great bond returns. And sorry, but it kind of brings it back to, it all depends on your timeline. That 5-year bond is safe if you only need the money in 5 years, but that bond may not be. I mean, we bought a T-bill for somebody a couple of months ago. They called me a week later. They're like, I thought there was no fees on this. And I said, well, there weren't. And they said, well, how could it be down in value? And I said, well, it can't go down much because it's got a very short duration. It's a T-bill, but interest rates went up. So the value of that bond. So even on a T-bill, you could have a fluctuation in value in the account. And it's important. Again, I hate to keep coming back to like education, 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 like even people who think that they understand DIY and I don't need the help of an advisor or whatever, and that's fine. But there's way, way more intricacies to something as simple as the S&P 500 than most people think.
Yeah, and I think too that going back to going back to the impact of bonds and S&P and the stuff you're talking about. I mean, people also don't understand primary market versus secondary market, right? So, if you buy a primary bond on issue, there's no valuation shift. You hold the thing to duration and you get your, as long as it doesn't default, you get your interest and you get your value. Secondary market, once it's packaged and is able to be traded amongst people, changes everything. And that's where you get bond volatility. Because it doesn't matter if interest rates go up and that, against long-term, intermediate, or short-term, unless it's tradable. Because at that point, everybody's going to want to dump the secondary bonds that they're holding because, hey, I used to get 4% when my bank was paying nothing. That 4% sounds pretty good. All of a sudden, I'm getting 4% when the bank or the treasury short terms are paying 4.5%. That 4%, long-term bond sucks now. I want to get rid of it. Well, nobody wants to buy it. So boom, valuation fall. So people have to understand what the difference is about holding bonds and how they're packaged too. But all this comes back to the education, right? And it always comes back to like what Kirk said in the beginning. Well, what would I advise someone if I'm not helping? This is way too much for most people to learn. And that's why it gets very complicated to give advice about doing any of these things because people they do not have the capacity, time, or knowledge to watch this at a level that would allow them to do anything more than something probably static.
Well, and it's the media doesn't help a lot. I was just going to say, Doug, to your point about like, the Wall Street Journal, I do it in the pieces that I put out. Every time I say, bonds were higher because yields were lower or whatever. One of my biggest pet peeves, CNBC's good for some stuff. They're mostly targeted towards institutional investors. I usually have them on mute. I like the data. They're pretty real time on data. But one of the things that drives me nuts, like one of my biggest pet peeves, is if the yield on the 10-year goes up, they highlight it in green. And if the yield on the 10-year goes down, they highlight it in red. And I'm like, hang on, you're sending like the absolute wrong message here. Yeah, no, yields up should be red, yields down should be green, price wise, but I digress.
Yeah, the media, we could spend multiple conversations just shooting holes in that one. I mean, yeah, it's that emotion. It's not only is it bad data, it's poorly disseminated data. It's all driven, as we know, to sell to build emotion and sell advertising. So yes, listen, if anybody's listening to this, the last place you want to do is go out there and get your financial recommendations based off the news. I've talked about this before. I know people, they would say, come to New York, we're going to put you on the air. And then they'd interview them all at over the night and then say, okay, you have the most extreme take on this side. You have the most extreme take on this side. The rest of you centrists go home. They're there to stir emotion and mess with your mind.
That the last firm I worked for, so we're factor based.
Mm-hmm.
So basically we believe in, buy and hold and use these factors like value, momentum, quality, low volatility, and size. And, don't time the market, don't trade anything. So we were invited to New York to sit down with Market Watch, which is, it's the website I always have up because they've got all the data that I want there. But we sat down with this poor guy. He sat there and interviewed me and my head of research. And after about 7 minutes, he's like, all right, I think we're done. Because we had nothing to say other than we believe in these factors and you should buy and stick with it and don't time the market. And he's like, yeah, but what about he's trying to get us to say something sexy, and we're like, that's just not how we do it.
Yeah, it just didn't throw in enough controversy. I mean, if you talked about heroin, you might be able to get on the show.
Right, exactly.
That was throwing that out for Kirk. That's a long running inside
plot
joke
against the government or something like that. Right. That would have been more appealing for them.
Exactly. Well, just for your reference, Tim, I also put CNBC on mute. I also put it on visual mute. Which is the off button. So
it's called having your TV off, Kirk.
Yeah. I stopped watching them 20 years ago. There's really no redeeming value in that station.
All you had to do, go in there, buy, sell. That's all you needed to throw a couple of those in there, and you would probably have your own show.
Yeah, or I could start up an ETF that fades Jim Cramer and does the exact opposite of what he does and do really well. So
have you seen that there is a Twitter site out there called Inverse Cramer, I think it's called. It's all about doing the opposite of what he does. So
no, there is actually an ETF that does the opposite of what he does. It's done reasonably
well. I wasn't even aware, which tells you how little I care.
There's an ETF that does the opposite of Jim Cramer, and there's one that does the opposite of Kathy Woods. And they've done pretty well. So it just, to me, it's funny. But anyway, as we kind of get to wrapping up the show here. So Doug, final thoughts from you, and where can people find more about you?
Final thoughts from me on this is, listen, for most people out there, if you are, well, listen, a couple of things. If an advisor talking to families, here's the thing, one thing I didn't get in earlier is, listen, we know that the new word of the decade, I don't know how recent it is now, is mansplaining. I think that's one of the things that also becomes an issue with communication. Women are increasingly the biggest earners in the household, not only controlling the money, but making more than men. If you're an advisor out there and you're listening to this, make sure that you're talking to them, because you may be surprised that the person you're talking to might not be the one that actually makes the decisions. And, ultimately it doesn't have the money. And that's because it's a very old school mentality. Make sure you're talking to both. Make sure you're talking, they talk about talking their love language. Make sure you're talking in their love language when it comes to finance. So you make sure that you're inclusive to both sides. More than ever, I think that dynamically, we're not seeing the same kind of divorce rates we used to see in other generations. More households are much better at communication, much better of inclusive of each other. And I think it's really critical. I think it's a great thing that families, the husbands and wives, or however you may be, they're making these financial decisions together, and you need to be talking to both of them. And if you are going to not work with someone, and if you're trying to do this on your own, the first thing you need to look at, and the most important thing you need to look at, is understand cash flow. Go back, do your budget, know where your money's going, make sure and make sure you know why behind what you want. What is it you're trying to build this towards? And what is that number that's truly going to give you the freedom to do the things you want? And don't try to do more, because that's when people start to lose get that disconnect between money and values. And that almost never ends up being in a good place. It can create financial stress between the couples. It can create taking risks that you wouldn't otherwise need to take. Know what that is. Pull that dream together. Again, if you're a business owner, now let's transition. If you're a business owner and you're trying to build that dream for yourself and your family, and you want to know what that value is, and you want things to be effective and efficient, and or you have another company that we're involved with, ProCollege Planners. If you have kids you're trying to put in college, it's all about the vision, right? Understand that it's all about the cash flow. Go download the free checklist that we have. If you're a business owner, it's going to be automaticbusinessmethod.com. 9 steps to helping you have a business that can thrive without you. That's going to be a better work-life balance, especially in this new economy. And if you're a family with kids going to college, go get our 9-step checklist at procollegeplanners.com. You can't afford not to.
Great. Well, thanks for coming on, Doug. Tim, what about you? Final thoughts from you, and where can we find more about you?
Yeah, just as I was listening, I was trying to think like, what's the one thing I would say? And so at my time at BlackRock, one of the greatest things that was ever said to me by a boss was, Tim, you take the time with your team to explain why we're doing what we're doing instead of just barking at them like what to go do. And as somebody who's constantly trying to educate other people, that was my main goal, was not just, hey, here's what you need to do. What is it we're trying to accomplish here? So whether you're single, married, divorced, planning for college, planning for retirement, buying a house, whatever it is, it's important to sit down and say to yourself, what is it I'm trying to accomplish? That should be the first question of any financial discussion. And I would just echo what Doug said. Step 2 is figure out what's coming in the door and what's going out the door. Because you're just going to make all kinds of mistakes if you don't. You're going to start setting money aside for investing that you can't really afford to set aside, or you're going to wind up with a lot more cash than you need, and you're going to watch investment returns go by the wayside. So the way we try to accomplish that for people, I started this company in 2018 with the objective of helping people uncover and reduce fees, really avoid all of the non-transparent fees. Kirk, you and I have spoken at length about mutual funds and annuities and things like that versus exchange traded funds. April is Financial Literacy Month, so you can follow us, Metric Financial, on Facebook, Instagram, or LinkedIn. We've talked every single day this month, and we're going to keep doing it for the next few days. All about mutual funds versus ETFs, hidden fees, high fees, all those kinds of things. But yeah, we're trying to take a much more inclusive, holistic look at people's portfolios at a significantly reduced cost. And the easiest way to find information for us is www.metricfin.com. And I realize people call me old for including the www, but I just can't help it. I keep saying it.
Hey, and listen, here's your little fact of the day. I read this the other day. It actually takes you longer to say www than it does to say World Wide Web.
Than it does to say the actual website. So, okay, visit metricfin.com.
It actually takes you longer to say www than World Wide Web. So if you said World Wide Web,
there you go. There you go.
It'd be faster than www.
I'm right in the middle of speed of getting it out there.
Nice. Well,
Thank
Tim,
you, Kirk.
Tim, appreciate you coming on the show. Thanks again for joining us, both of you. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.